China is dominating the headline news these days. In today's episode, we would like to share our insights based on our bottom-up research and local knowledge. Given the geopolitical tensions, we have seen foreign investors, especially the US capital, returning to their home market. Wenjie, how does this impact China?
Chinese bond and equity markets are relatively small compared to the country's presence in the global economy and trade. China accounts for 20% of global GDP and 15% of global trade. In comparison, Chinese bond and equity market accounts for 14% and 11% respectively. In the Chinese financial market, the foreign investors are increasing their presence but remain relatively small. In the bond market, foreign investors held $2.8 trillion by the end of 2021, up 14% year-on-year. This accounts for 15 to 20% of Chinese bond market. There has been a significant increase in allocation to China since 2017. This is not only because China offered more attractive yield than the US market, or in other words, the yield spread between China and the US was increasing, but more importantly, global investors became aware that China is underpresent relative to its GDP and global trade contribution. Therefore, in 2018, even though the US 10-year government bond offered a higher return than China, the flow to the Chinese bond market did not stop. Foreigners' presence in the equity market is even smaller than the bond market. Combined, foreigners held 16% of Chinese stocks in terms of market cap. However, for the onshore or A-share, which account 3/4 of the Chinese stocks in terms of market cap, foreigners hold only 5%. Most foreigners hold the offshore H shares. It is therefore no surprise that the foreign investors' flow had more impact on the H share than the A share valuation. In the HSC China Fund, A share currently accounts for approximately 70% of the portfolio. We are actively looking for investment opportunities that are under researched by the global investors.
The COVID situation in China is worse than several weeks ago. What is the impact on the economy, and where do we see China is heading?
The Omicron variant has caused infection rate to pick up in China. In mid-January, Shenzhen, which is a Chinese Silicon Valley with 13 million population, saw the infection rate picking up. With an early lockdown and aggressive testing, daily infection rate peaked at below 100 people per day in 2 weeks. In late March, Shanghai, which is the economic center of China with 26 million population, recorded an exponential growth of infection rate, and the daily cases are approaching tens of thousands. We are confident that the COVID situation in China will normalize in the coming weeks. Because of the centralized political structure, Chinese government is efficient in allocating capital or resources during external crisis. This was illustrated, for example, during the first outbreak of COVID in Wuhan in 2020, and by the aggressive fiscal spending during global financial crisis in 2008. In terms of the economic impact, the first quarter 2022 GDP growth is likely to undershoot Chinese government's full-year target of 5.5%. Some estimate that there will be $46 billion or 3.1% impact on GDP from the current lockdown per month. Supply chain disruption that will impact the rest of the world are unavoidable. To achieve the full-year GDP growth target, we believe the Chinese government will continue its accommodative monetary policy and increase fiscal spending, such as infrastructure spending. The NDRC presented in March a plan to move forward important infrastructure projects such as railway, including subways, harbor, motorways, and cold chain logistics.
What are the investment implications based on what we see in China?
From macro perspective, we are monitoring the regulatory situation, supply chain issues, and the US Federal Reserve's interest rate policy closely. After Russia was deemed as uninvestable due to the conflict with Ukraine, some suspect that this will also become a structural risk for the Chinese financial market. We believe that the nature of capital is to always seek return. Russia and China are by no means comparable given the importance of China for the world economy. Based on the consensus data, among the companies with more than 10% top-line CAGR for the next 3 years, 40% are in China. We think it's wrong to conclude China will follow the path of Russia. The HSC China Fund's ambition is to hold the best 25 Chinese companies based on their inner strengths, valuation, and relative attractiveness. We will continue to look for opportunities which best fit our investment criteria. We remind the investor that the secret sauce to success is through long-term investment.
That's it for today. Thank you for watching and hope to see you again in the next episode.